Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Monday, November 4th, 2024, a couple days before the election. The 10-year US Treasury yield is up at 4.3%. The gold price is above $2,700 an ounce still. We have a returning guest. She is the CEO and chief strategist at Quill Intelligence Research. She used to work at the Dallas Federal Reserve Bank, also on Wall Street. She also wrote the book, and it is excellent. I highly recommend you read it if you haven't read it in the past. Fed Up, an insider's take on why the Federal Reserve is bad for America. Danielle DiMartino Booth, thank you for joining me again.
Great to be with you.
So Danielle, we're a couple days before the election, and before we talk about the U.S. economy and the election's impact maybe on spending here in Washington, D.C., I want to get your thoughts on the global economy. Do you think there's a lot of evidence that the global economy is already in a recession?
Yeah, I think there's ample evidence thereof. For a while there, we were just talking about Germany's factory sector in isolation, but we're hearing from more and more sources that the recession has definitely spread into France, and those are, of course, the two largest economies in Europe, and that China is in an effective recession right now. There's still some household savings that are being deployed by Chinese consumers, and that's been something of a support. But from everything we hear from luxury goods purveyors, the situation in China right now is very dire.
So do you think that that's why these central banks have announced that they're starting to cut interest rates, or do you think that there's some other reason?
No, I think the central banks right now are really behind the curve. The Fed should have, I think, by all indications, given the downward revisions that we've seen and the escalating string of bankruptcies, the Fed kept policy too tight for too long. And I think a lot of central banks were caught on their back foot by trying to wait for the Fed. And now they're combating recessions in their economy. So it becomes a question of, when economies fall into contractions, sometimes it takes a long time for the lag effects of the prior tightening to finish moving their way through the economy. Just today, since the market closed, we've seen 4 major layoff announcements, 3 large bankruptcies today. That's just in the United States. And of course, we're hearing from the likes of Volkswagen that they're going to be closing down factories, plural, and laying off upwards of 30,000. Boeing made their initial announcement of cutting 10% of their workforce of 17,000 permanent a few days ago. They're not going to be furloughed. They're going to be permanent. So again, this is when central banks attempt to play catch up for having waited too long to start easing policy.
Yeah, I saw you on business television the day that the Fed announced a 50 basis point rate cut, and you were talking on business television how basically they probably should have started to cut rates in July, but that the 50 basis point rate cut was a catch up.
Yes, it's definitely been an attempt at playing catch up. Yes.
Now, these other central banks that started to cut rates before the Fed, do you think that they're going to also start to add liquidity soon too? Or do you think that they preemptively started cutting rates for the Fed and then we're waiting for the Fed to cut more so they could cut more? What do you think the other central banks will do now that the Fed has started to cut?
Well, I certainly have not heard any indications of quantitative easing being restarted. In fact, the New York Fed put out a seminal report a few weeks ago detailing reducing the Fed's holdings of mortgage-backed securities through the end of the year 2035. So I think that the difference between now, say, and when the pandemic hit is that lowering interest rates should not be perceived by market participants as being in any way, shape, or form equivalent to adding liquidity to the markets. They really are two separate discussions. And there's a lot of misinformation on social media that tends to conflate one with the other. Again, I think the Fed may be tapering the shrinkage of its balance sheet on the Treasury side, but it's laid out a blueprint to continue shrinking its mortgage-backed securities really for the next 11 years.
Now, this spike in M2 that's occurring, that's in the commercial banking system. Are the commercial banks actually increasing lending into the real economy, or why do you think then the M2 has started to spike in the private sector for commercial banks?
Well, actually, M2 is contracting. We got a very large contraction report out about that just a few days ago. And what banks are doing right now is they're shrinking their commercial and industrial loan book. And the flip side of that is we've seen double-digit growth in lending to the private credit sector. That's the only area of growth that we're seeing as we start to see more and more banks really cutting credit off to the economy because we're seeing a lot more price discovery on the commercial real estate side that is impairing their ability to grow loans.
So by price discovery, you mean that like they're taking mark to market losses. So even though the Fed is reducing interest rates, that's not really helping commercial real estate?
Not yet. And it will be, I think, a long time coming because the markets have, the bond vigilantes, so to speak, have done so much in terms of pushing the Fed to slow the pace of easing, such that we're only expecting another quarter percentage point rate cut at its upcoming November meeting and another quarter percentage point rate cut at its December meeting. You may recall that going into the year, there were hopes that we were going to see 7 rate cuts in the year 2024. And of course, we can already see Thanksgiving and the holidays over the horizon, and we've just seen a half a percentage point to date.
Well, I've been doing this for almost 15 years, and the dot plot projections are almost always wrong. They're almost always revised downward, changed later.
Exactly. And again, I think that the difference between now and then, especially because we are seeing M2 contract, is that the Fed is going to be playing a game of catch up here. Nobody can deny the downward revisions to August and September non-farm payrolls, which had nothing to do with hurricanes or the Boeing strike.
Now, with the mortgages, the Fed looks like it's going to start to cut rates more in the future. Are you surprised that the mortgage rates haven't started to fall? Because there was a temporary drop in the mortgages when the Fed announced the 50 basis point rate cut. A lot of people went out and refinanced or went and bought homes, but then the mortgage interest rates have started to spike again. Are you surprised to see that?
Not at all. In fact, if you look historically at prior rate cutting cycles, you tend to see the market front run the Fed's first rate cut, which is exactly what we saw, right? Mortgage rates fell in anticipation of that first 50 basis point rate cut. And then they ended up backing up quite a bit in the aftermath as markets began to reprice a much more conservative path of Fed rate cuts. So that certainly has cut off a lot of the momentum that we'd seen in the mortgage market in anticipation of a more aggressive Fed.
Now, before we started recording, you were telling me that you have a lot of insights into China. Would you describe the Chinese consumer as similarly bifurcated to the American consumer, where the more affluent Chinese consumer is still spending, or do you think that they're also cutting back?
Well, I think for several reasons. One of them is cultural. There's been a big clampdown on luxury spending in China, and there's been something of a shift uh, in terms of how they view obvious, ostentatious forms of consumption. We're hearing from everybody from Gucci to LVMH that they're seeing a huge pullback in Chinese affluent consumption. That being said, Chinese households are sitting on quite a bit of savings. It's fairly foreign to US households that there be such high savings rates in other countries. But of course, their economy was shut down for much longer than that of the United States, and their property slump is much more protracted and deep than that which we're seeing in the United States. That's why my friends over at the China Beige Book say that even though the Chinese government is trying as aggressively as they can to convince the public that they're going to be easing measures, they really have not been able to loosen up any kind of action in their own property sector.
There was also a record cash withdrawal out of the Chinese banking system back in April, and physical gold demand and silver demand for a lot of the middle class or upper middle class is at record highs. So I think like the spike in Bitcoin, physical gold and silver prices, I think at one point it was a $6 an ounce premium differential for buy physical silver in China compared to the US. So there was like a huge demand for it over the last 12 months in China for physical metal, basically alternatives outside of Chinese real estate and Chinese stocks.
Yeah, we're definitely seeing that kind of flight to quality, that defensive posturing. We certainly have not seen that in the crypto space. That's been, I think, attendant with the quote unquote Trump trade and people trying to get ahead of what they believe is going to be potentially a friendlier administration towards the cryptocurrency space. But you're, of course, seeing a lot of vacillations. It's going to be, who knows what the outcome of this election is going to be. So you're seeing a lot of back and forth with some of that trading.
So I want to ask you about the state of the U.S. consumer heading into the election. Would you describe the U.S. consumer as bifurcated, or do you think it's something else?
Well, we've definitely seen kind of this K-shaped economy, right? 20% of the top earners in the United States account for more than double that in terms of their consumption. And you see the mirror image of that with the bottom of the K, if you will. The lowest 40% of income earners are only responsible for 20% of consumption. And we're seeing car repossessions run at a very fast pace. We're seeing credit card write-offs accelerate. It looks like we're going to surpass the 2010 high point that we had for credit card charge-offs, and that is making banks pull back on lending to an even greater extent, which is, of course, kind of again, these are the lag effects of a Fed that was too high for too long, and now we're seeing a lot of credit being cut off to anything but the highest income earners.
And that's with over $150 billion reported as of a couple weeks ago, student loan debt bailouts. And it sounds like there's going to be even more. The current administration is just ignoring the Supreme Court rulings for that. I was watching the State of the Union speech in February, and Biden was openly talking about going around the Supreme Court to get the student loan debt bailouts. Maybe it was a bribe for the election.
That's certainly one way to look at it. And I don't think that the Supreme Court is going to sit back and allow for its ruling to be completely ignored. I think that there will be lawsuits that press forward going forward because the Supreme Court has basically seen this current administration thumb their nose at the ruling and try and use a bunch of one-off sources of student loan forgiveness, but it really is starting to add up. And again, I doubt that the attorneys of the world are going to sit on their hands and not do anything about this. So I think we will see further cases come up in front of the Supreme Court.
Now, I want to ask you about the budget deficit projections and for either political party going forward post-election. Do you think we're looking at around $2 trillion or more base case budget deficits going forward in perpetuity?
Well, I think perpetuity is a really big word. I do think that we have $1 trillion interest expense on a per annum basis, as far as the eye can see. There's very little, though, that can be said with certainty. There's very little visibility right now about what the form of future deficits are going to take. Of course, the aging of America is swallowing up a greater and greater degree of spending when it comes to Medicare and Social Security. That being said, if there's theoretically a Trump victory, we're not going to see, I think, a lot of inflationary type of fiscal spending because he'll use his initial political capital to extend those tax cuts. And that won't be pumping any fresh money into the economy in the form that we saw in the post-pandemic era of direct depositing cash into U.S. household accounts, which is, of course, what caused that double-digit inflation to occur after the first and the second and the third stimulus checks were written.
Do you think then that the banks are going to come out of the commercial real estate bubble unscathed, or do you think that eventually they're going to need bailouts in the next year or two?
I'm not sure about bailouts. If we were going to see bailouts for the commercial real estate industry, for heaven's sake, we would have seen them a long time ago. We've seen billions and billions of dollars of losses that have been realized. I do think that the FDIC is struggling to forge bank mergers in the current environment, and that we're going to see, a very continued slow play, as much extending and pretending as there can be, because banks are still sitting on very large losses that are tied to their treasuries and mortgage-backed securities holdings. So it's very difficult from the position of regulators to bring banks together, acquisitions, if you will, if one bank is asking to absorb the losses of the other, in addition to the unknown of the losses in their commercial real estate portfolio. But again, I think it's almost fanciful to talk about a bank bailout, given all of the blood that we've seen shed in the commercial real estate space. We're seeing some buildings trade for 67%, 97% in one case discounts to where they were last financed.
If they're trading at that much of a discount, why haven't the balance sheets then been adversely affected then? Do you think then that they're not marking to market the losses yet, that they're just liquidating what they can for cash and they're not marking the losses yet?
I don't think that we've seen all of the loss recognition that we are going to see. These things do tend to look like a great big bell curve. So we're still at the very beginning of that. We did see a big story out of Bloomberg last week, however, that said that the AAA tranches of commercial mortgage-backed securities are beginning to see losses for the first time since the financial crisis. So we are seeing losses manifest. It's just not necessarily on bank balance sheets or in the form of failing banks yet. There's I think Wisconsin's largest bank was on the wires a few weeks ago, saying that its commercial real estate loan losses are going to become very problematic. So again, I think what you need to appreciate here is what we were talking about 18 months ago, and that was mark-to-market losses on Treasury and mortgage-backed securities holdings that are getting in the way of banks being able to do anything but extend and pretend on their commercial real estate holdings for the moment on those loans.
That's interesting. I think also the insurance companies and the pension funds have a lot of losses, and the pension funds obviously are not publicly traded. So it's not like they have to disclose all of these things like immediately. They can hide these things for a while.
That's exactly right. That is exactly right. And I think that life insurance companies have also stepped back from making fresh investments into the commercial real estate space because of this, because they are still sitting or already sitting on losses.
I see the Congressional Budget Office projections, Danielle, and I'm just scratching my head because weren't they projecting that the national debt, it would be by 2030 that we get to 40 trillion, and here we are, we're almost to 36 trillion. They added over $500 billion in fresh debt in the last like 6 weeks or under 6 weeks. We're headed towards 40 trillion way faster than the Congressional Budget Office is projecting.
Yeah, I think that right now, I've seen other projections that suggest that it'll be at 50 trillion by the time we get around to another 10 years or so. And at some point, you have to ask yourself, I understand that China's on its knees. It's got its own banking and financial system crises that it's dealing with. But at some point, you have to ask yourself if there's going to be a world event that will cause there to be a hard stop at a US Treasury auction. I don't see that happening in the near term, but it's certainly not something that we can take for granted indefinitely.
Okay, so you think that China's economy is the worst problem for the global economy then?
I think China poses a very large drag for the global economy in the sense that in 2009, 2010, that they were able to pull the world economy out of recession. In 2015, 2016, they were able to pull the global industrial recession out of its contraction. And right now, what we're seeing is the Chinese government pour as much stimulus as it can into its manufacturing sector, which is really bringing about the risk of a trade war, not just with the United States, but with other countries as well, as its manufacturing sector dumps products here and there all over the global stage, trying to get what growth that it can from the usual suspect of its manufacturers.
Well, you're seeing politicians, at least, and bureaucrats talk about putting huge tariffs on what Chinese solar panels and Chinese electric vehicles. So I'm sure they'll try to figure out a way around it. But it looks like we're kind of headed towards a lot of protectionist policies, not just what the Trump administration is talking about.
That certainly could be the case. And again, I don't think that this is going to be a situation that is isolated to the United States. I think that China is desperate to get liquidity and funding into its country, such that it might end up stepping on toes outside of U.S. Borders.
I want to get your thoughts on this nuclear power and data center boom. Do you think that this is a really powerful long-term trend and is here to stay?
Well, it's interesting you asked that question because there is a paper that came out of China that showed, I think, something actually very hopeful, and that is that you need a lot less in terms of data center capacity to get the same amount of storage. And in fact, I think the number was close to 87% less space. So one of my concerns, and I've written about this for my clients, is that the United States might have an overabundance of data centers. We, of course, have 10 times think 5,500 data centers. It's about 10 times the number of what Germany has, for example, or China. And I think a lot of the efficiencies that are being realized with a lot less in terms of power needs is going to be something that could potentially introduce kind of a fiber optics 2.0 situation, to where we wake up one day and realize, oops, we built too many data centers.
Well, some of the current data centers, they're mostly for latency. So for like Netflix and YouTube, they're for people on social media and surfing the internet and streaming, uploading and movie service. The next generation data centers, I mean, like Germany, you mentioned Germany. Germany does not have an Amazon, a Google, a Microsoft, a Meta. They don't have those giant big tech companies with the large market caps that can spend tens of billions of capital expenditure per quarter. So they don't have the tech companies that we do.
No, that's correct. They don't. And of course, we know that what the energy needs are coming from. But at the same time, again, my concern is more that the rest of the world has moved on and that we don't need near as much space as we thought we did. There's nothing quite like an American craze to overdevelop. It's certainly not something that would be new to us.
Yeah, I haven't seen any accurate estimates for other countries and their technology companies or governments for building these next generation data centers. Most of the estimates I've seen, I've looked at a lot of different ones. They're mostly for the American ones. I mean, I saw one for projecting for China, but it was so like, I think it was 10 times the amount of power usage of the future US ones that are being built by the 2032. It just made no sense. And I have no idea where they even source the data from.
Well, look, anybody can, call me a cynic, but you can pull data out of anywhere you want, and I'll let you finish that thought.
Well, I was going to ask you about like long-term trends in this environment, or do you think that investing long-term is very, very difficult in the current environment?
I think that we're seeing, the highest degree of concentration in the US stock market since 1929, and that certainly means that when you have a large chemical company cut its dividend by 95%, which we heard today, you have to be very careful in terms of the types of companies that you're going to be investing in, and look not necessarily at their bottom line, but more so at their capacity to generate revenues and how safe their cash flows are.
Yeah, I totally agree. I mean, look at what Warren Buffett's doing. I mean, he's been selling certain types of stocks, like a lot of Apple. He's selling Apple shares and Bank of America shares.
Bank of America. Yep. Mm-hmm.
And loading up on cash. Isn't he one of the largest holders now, US Treasuries?
He is indeed, and he's sitting on a huge pile of cash, and he just took a very large, substantial loss on his insurance holdings, something rare to see out of Berkshire Hathaway. So yes, I would certainly uh, think that people should be paying attention to how very conservative Berkshire Hathaway is being right now.
We just have weird market conditions, Danielle. It's like a lot of cross currents going on because I look at the real economic data and I see a lot of companies that cater to the middle class consumer, lower middle class consumer, and they're hurting. But then you look at the Dow Jones Industrial Average, the S&P 500, the gold price, the Bitcoin price. I mean, these things are all like either at or near an all time high or very, very close. So it's a very weird market conditions.
Yeah, I mean that's an understatement. um, That's a huge understatement. I don't think I've ever seen such a confusing market. And of course, it's very frustrating for investors because they don't want to be, quote unquote, left out. So they want to be there for the very, very, very last inch of the last mile of the rally. And when you're seeing the VIX index stay persistently, around 20 or above 20 when stocks are near their all-time highs, it's a very unusual dynamic. Normally, you don't see volatility rising if stocks continue to go up. So decidedly confusing backdrop. We're seeing a similar dynamic play out in bond market volatility. We are seeing the MOVE index increase, for example, on a day like today when we're having this discussion, despite the fact that the benchmark yield on the Treasury fell more than 10 basis points to 4.28%. So markets are a sea of confusion right now.
What do you think would have to happen for the Fed to want to start accelerating the interest rate cutting cycle then?
Well, I think that Fed officials have been very forthright in saying that if they see an acceleration of job losses, that they will become more aggressive in their rate cut path. That being said, it took 5 quarters in the first quarter of 2001 before we found out that the first quarter of 2001 actually was a negative GDP print. The same thing for the first quarter of 2008. It was 5 solid quarters of GDP reports before we found out that, in fact, what had originally been reported as being a positive number was actually a negative number. So difficult for the Fed to use data that, generally speaking, looks backwards in time when so many revisions going forward are going to be negative.
Are you talking about GDP revisions negative? Because Jerome Powell, and I was surprised what this was like 6 or 7 months ago, he was actually calling out the Bureau of Labor Statistics for the revisions on the jobs reports. I was shocked to see someone that high up at the Federal Reserve Bank saying, like, one of their public speeches to call out the Bureau of Labor Statistics for revising the jobs reports down that much.
I was kind of proud of him myself for pointing that out. I mean, it's becoming a systematic state of downward revisions that is really embarrassing. It's if we're traveling back in time to the former USSR.
Well, I think it's intentional. I mean, it's to promote a narrative, right? As when the election's coming up, there's certain goals with the whatever administration's in power. They want to do what they can to try to increase the odds that the incumbents stay in power, either in Congress or in the White House.
Well, I think that's the case, but we've seen downward revisions to payrolls since the beginning of 2023, for heaven's sake. I think that speaks to more than an election cycle.
Yeah, it's just very frustrating. It seems they get more and more egregious though the long.
Oh, look, you are so preaching to the choir completely.
Well, at this point, Danielle, both political parties, I mean, I don't really hear anyone, and I've lived outside of Washington, D.C. for almost 25 years. I don't really hear anyone in power in Congress or the White House actually talking about significant spending cuts. It's the opposite, in fact. I mean, I'm hearing, like, from Republicans, if they get back into power, they want to spend more on upgrading military technology. And I've seen estimates from over $1 trillion to $10 trillion. There's like research reports coming out that we need to invest way more into military technology upgrades to compete with China and Russia.
Well, I mean, right now we're spending more on interest expense than we're spending on military. So I think that there are certainly other things to concern ourselves with, and that is what you brought up earlier, and that is the absolute level of the debt and how quickly that debt is being racked up, and how much the United States is spending on forgiving people's contractual obligations. And I think that that's the word that we should use to describe what the debt that's being excused is. Student loans are a contractual obligation, and we're spending a lot getting rid of them. We're spending a lot on interest expense. And, going back to my Econ 101 days, these are called sunk costs. At least if we're investing in military might, so to speak, that might be something that is beneficial to the sovereignty of the United States going forward, not costs that we piss into the wind.
Well, a lot of the policies are trying to fix the demographics problem here in the United States. So whether it's immigration or now like buying off the student loan debt, I mean, they're just throwing stuff at the wall here. And some of it's like, the bailouts with the student loan debt. It's definitely trying to fix the long-term demographics problem too.
Well, it's going to be difficult to fix something like that. There's no denying that the aging of America it's a train you cannot slow down.
As we wrap up here, how do you think should people be more cautious here with cash and playing defense? And because you said how difficult it is with the environment, the macro cross currents, it sounds like a lot of long-term investing here at this stage is very, very difficult.
Yeah, I mean, I don't envy investors who want to put cash to work in risky investments right now. We know where valuations are, but valuations certainly aren't any kind of a timing technique. That being said, you're still getting north of 5% on your cash. So in that sense, you're still able to enjoy compound interest and watching your investments grow in a very safe way by sitting on the sidelines. I know that's not glamorous or sexy, but again, if you do want to be exposed to the stock market, or if you do want to own corporate bonds, then for heaven's sake, do your homework and make sure that the dividend or the payments on the debt are not at risk of being cut.
Okay, so by payments on, oh, you mean on a corporate bond? Okay, so because a lot of companies still have debt on the balance sheet if they haven't refinanced. A lot of small caps have revolving credit facilities that have gotten hurt badly by the higher interest rates.
Oh, of course. And that's why we're seeing again, that's why we're not seeing any real let up in the corporate bankruptcy cycle to speak of. And in fact, the corporate bankruptcy cycle is now starting to feed into the household bankruptcy cycle.
Do you still think we're going to have supply side problems for a lot of these key commodities for like copper and energy and other key industrial metals? Because when the Fed kept interest rates high, I mean that canceled a lot of commodities projects too.
I think that remains to be seen. If there was more demand coming out of China, I think that you might have a better discussion here, but there's not. And therefore, we're seeing OPEC constantly trying to chase its tail and cut production and try and shore up commodity pricing because the deeper issue here really is one of global demand. And I think that that's going to be really where you're going to eventually see when you see India becoming, coming more of age and increasing their infrastructure. Not that we're going to see anything out of India, the likes of which we saw out of China, but I think you need at the margin a greater source of fundamental demand for a lot of these commodities before you see any kind of traction there.
There's also been supply side on the cost side because there's been a lot more inflation outside of the United States, according to the inflation data for other countries. And that's where a lot of the mines are in oil and natural gas projects. So the cost to maintain or build like a new mine or a new oil and gas project that's sizable, I mean, these costs are up a lot over the last 5 years.
Without a doubt. And that certainly makes things, that much more difficult. But again, for the moment, I think the prevailing concern is on the demand side rather than supply side.
Well, last question here. If you were to rewrite your book and add a new chapter to Fed Up, do you think that you would change anything?
I think that I would, if I was, and this is a question I think about quite a bit actually. If I would add a last chapter to Fed Up, it would be one that applauded things like the report that I mentioned to you earlier that the New York Fed put out, that they're planning to reduce very aggressively their mortgage-backed securities, and that it sounds like they're planning on also trying to not revisit the zero bound. These are types of developments coming out of central banks that I would applaud, that they recognize in actions, not just words, but by way of action, the fact that the zero bound was an utter failure and that credit easing in the form of buying mortgage-backed securities was also a failure that ended up making housing less affordable than it's ever been in the United States. So that would be the chapter that I would add, would be to press forward as much as the progressives are kicking and screaming, wanting to go the other direction, but to press forward and be accountable for and recognize failed experiments in monetary policy by trying to expand the toolbox to too great of an extent.
The other major issue here is DC spending, because even if the Fed wanted to cut back, I mean, Washington, DC, both political parties in Congress or whoever's in the White House, no one really seems interested in drastically reducing spending. So I think that's the other major issue here is when you talk to the higher ups here in Congress, they want to spend more. I mean, they all have their projects that they're picking out or they're trying to horse trade or trade votes. So that's the major issue here. If DC wants to spend like crazy, the Federal Reserve Bank is kind of beholden to what's it, fiscal dominance.
Yes and no. The Federal Reserve does not have to monetize debt. That is a fallacy. So they only have to play a role to the extent that they choose to play that role. The Fed has the blunt instrument of interest rate policy that will and can, especially if they're vocal about it, be a stopgap measure as long as they're independent in their policy and make it that much more difficult for everybody in Congress and the White House to spend like a bunch of drunken soldiers. The Fed does not have to go along. I think that that is, again, a communication failure on the Fed's part. They need to communicate uh, more to the outside world that they are not simply pawns, that they are not, that Congress is not their puppet master and they their puppet.
Do you see other major central banks like the Bank of Japan or European Central Bank coming back into the treasury market and starting to buy net treasuries in size? Or do you see the trend that they're going to continue to buy gold tonnage instead?
Yeah, that's a good question. I think it's really going to depend on the rate differentials and where they are. whether or not there's going to be more appetite. I certainly don't think that I don't lay awake at night and worry about the dollar and its position and or treasuries, because we're pressing forward with central clearing of treasuries, right? So that's going to protect the sanctity of the US Treasury in terms of international trading and its position as the world's risk-free asset. So I don't worry so much about other countries, namely because their banking systems are more laden with bad debts. Europe still has yet to shed off all of the bad debts from the last financial crisis that we had. So I worry a lot less about fiscal dominance, especially when the type of fiscal spending that we've seen is more pork belly in nature and much less in the form of directly depositing cash into US household bank accounts. It's when you bypass the banking system and directly deposit cash that you ignite inflation, and that therefore you get discussions of fiscal dominance coming to the fore. As things stand right now, unless the polls are completely wrong, it looks like the Senate's going to go back into the hands of the GOP, and that we'll have a little bit more check and balance on the type of spending that we have going forward. And for that, I am hopeful.
So by pork belly spending, you mean like when Congress was deciding with the Inflation Reduction Act or a variation of the Green New Deal or other types of infrastructure bills, that they were decided to spend hundreds of billions of dollars on what, wind, solar, biofuels, electric vehicles, those types of things?
Yes, I mean my textbook answer is, using gallows humor and being sensitive to the fact that it is truly just dark humor. For every $1 billion that the United States funneled through to Intel Corporation, they seem to fire 1,000 people. So as long as pork barrel spending is not making its way directly into the economy, you're not going to see it manifest as inflation. You're going to see it manifest as wasteful taxpayer spending.
Yeah, I agree. This area here, the DC metro area here is a bubble. I mean, they just keep coming out with new research reports about how to spend tens of billions, hundreds of billions, even trillions of dollars more. It's oblivious to the fact of the reality of everyday Americans outside of the DC metro area.
I'm happy I don't live inside that bubble.
Well, I report from inside here.
I appreciate that.
Well, I want to thank you so much for your time today, Danielle. Keep up the great work. Definitely watch you on business television. You do an excellent job there.
Thank you very much for your time. I appreciate it.